Hello and welcome to a discussion on Baroda Dynamic Equity Fund. Before I start talking about the fund, I want to spend a few moments talking about some broader concepts of investing. Equity, as you all know, and by extension equity funds, are probably the simplest way for any investor to create wealth, especially over long periods of time. But at the same time, equity markets also in the short term come with its share of ups and downs. And most investors I meet nowadays have a very common refrain. Is this the right time to invest? Haven't markets gone up too fast? What if the markets fall just after I invest? And what I find is most of these investors, while pondering answers to these questions, end up waiting on the sidelines. And it reminds me of two very, very important and powerful quotes from some significant and successful investors. The first is, successful equity investors always tend to buy when others are fearful and tend to stay on the sidelines when others are greedy. And secondly, and more importantly, time in the market is the most critical thing. It's not timing. And while we may always search for the ideal time to invest, I think you'll find that between all the possible factors that guide investing or not investing, it's really impossible to come to an answer. And the real answer is actually finding a balance between deciding whether it's an appropriate time to invest and making sure you give your investment the right amount of time in the markets. Before I even get further into that, let me just digress a bit. Let me go back 5 or 10 years, a world before which we didn't have the smartphone and we certainly didn't have the luxury of GPS maps. If you had a meeting to go to or you had to visit someone, frankly, back in the day, we all used gut feel or a sense of observation, right? I mean, for example, you said, I'm going to travel during peak hours, so it'll probably take me 20 minutes more than it otherwise would take. Or you use your gut feel. You know what, if I used this side road, I'd probably reach there faster. But you fast forward a world of today with the worlds of smartphone and more importantly, the world of GPS maps. The instinctive thing for most of us today is to first reach out to our phone, check maps and figure out what the likely time is going to be for that journey. How do these maps work? All they are doing is taking a visualization of the existing traffic on that route and the speeds of those vehicles and giving you a guesstimate. Does that change the traffic that's actually going to be on the route? The answer is no, but it gives you a perspective. And more importantly, and it certainly works for me, it reduces the stress of the journey significantly because you don't die wondering how long it's going to take because you have a sense beforehand. Dynamic equity funds are pretty much like that. They're equity funds, but equity funds coupled with a perspective on how the likely market scenario is going to pan out. And to use that particular fund idea, we basically use a proprietary model that evaluates all these valuation metrics, whether it be price earnings, whether it be price to book, yield analysis or dividend yield, to guide the fund manager who's managing the fund and gives him a fairly clear-cut guideline on the equity allocation he should hold. Obviously, to the extent that he doesn't invest in equity, the fund will then invest in quality fixed income instruments to make sure that your money works for you 100%. But the point is that the model allows human bias to play a very limited role in taking advantage of a market scenario. More importantly, besides the model, we also use our time-tested top-down and bottom-up investment approach to decide what the portfolio should be. A top-down analysis, more simply put, merely looks at the macro indicators, looks at various industry metrics and decides which sectors we want to be overweight or underweight in. And obviously, bottom-up stock picking is about looking at each company in depth and its valuations and deciding whether they merit a place in the portfolio or not. To me, a combination of these things is a very powerful combination over the long term. So, what type of investor is this suitable for? Well, the answer is pretty simple. This is an all-weather fund suitable for all investors who are using equity as a means to reach their long-term goals. And it will work across market cycles. So, you don't need to worry about valuations because the model will work for you. In fact, the model across the last couple of market cycles has thrown up positive returns over the equivalent benchmark in 6 out of the 10 years. But more importantly, it has made sure that your drawdown when markets are falling has been limited. And that is as important to an investing journey at times as creating wealth. Baroda Mutual has been managing money for many investors across equity and fixed income for almost a decade now. And we are confident that we can make this fund work for you just as we've done in the past. So I hope you'd consider investing in the NFO, which opens on October 22nd and closes in early November. And you can consult your financial advisor for help and more information. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.